Hi everyone, welcome back to Corporate Decoder, the place where we break down the confusing world of big business for you. Today we've got a filing from Binah Capital Group Inc. that promises some real fireworks, especially when it comes to their financials. Let's dive deep and see what's really going on under the surface. Alright, so this is an update to a previous filing, and it's all about what happened after a big deal called the business combination. Think of it as cleaning up the paperwork and sharing what's new with investors, especially those who got shares or warrants from that deal. It's a lot of shares potentially being resold, and that's always interesting. So here's the big story. They're talking about selling a lot of shares and warrants. We're looking at over 21 million shares that could be sold by existing investors. That's more than the company's already outstanding shares. This means a lot of people who got in early might be looking to cash out. This can really shake up the stock price. Let's peek at the numbers now. At the end of June 2025, the company was handling about $27.8 billion in assets. That's up from $25.1 billion last year. That sounds good, right? More money managed means more potential income. But hold on, look at the net new assets. For the 6 months ending in June 2025, they actually saw a net outflow of $1.1 billion from brokerage accounts. That means more money left than came in. So while the total assets managed are up, it's mostly from market gains, not new money flowing in. Their total revenue was around $90.4 million for the first 6 months of 2025. That's an increase from $82.1 million in the same period last year. So revenue is growing, which is a positive sign. But here's the kicker. Despite the revenue increase, they're still losing money. For the first 6 months of 2025, they reported a net loss of $2.3 million. That's better than the $0.7 million loss in the prior quarter, but it's still a loss. Now let's look at gross profit, which is basically revenue minus the direct costs of making that revenue. For the first 6 months of 2025, gross profit was $17.4 million, a nice jump from $15.1 million a year ago. This shows they're getting better at managing their direct costs as revenue grows. Looking at the expenses, though, they've gone up significantly. Total expenses for the first 6 months of 2025 were $89.5 million, a jump from $84.1 million a year earlier. That's a big chunk of change, and it's eating into their profits. A big chunk of that expense increase comes from employee compensation and benefits, which shot up by about 31.6%. This is likely due to the company now being public and needing more staff for compliance and other corporate functions. Professional fees also saw a huge drop of about 74.7% for the 6-month period. This is likely because a lot of those costs were related to the big business combination deal in 2024, and this year those one-time costs are gone. Now let's talk about what Binah Capital actually does. They are a company that buys and manages other wealth management businesses. They own 4 broker-dealers, 3 investment advisors, and 3 insurance companies with over 1,900 registered individuals. Their strategy is to be a top choice for advisors looking for a flexible platform. Here's a point that always catches my eye. They are calling themselves an emerging growth company. This means they get to slack off a bit on some of the stricter reporting rules for public companies. They can delay adopting new accounting rules, for example. This might make their stock less attractive to some investors who want full transparency. Now, for the part that keeps investors up at night, the risks. The company admits there are risks inherent in the independent broker-dealer business model. They are especially worried about misconduct by their advisors, who aren't directly employed by them. This could lead to legal trouble and damage their reputation. This is a pretty strong statement. They essentially say that because their advisors are spread out and not directly controlled, it's hard to prevent them from doing something wrong. This could end up costing the company a lot of money and damaging its image. And then there's the regulatory mountain they have to climb. Being a broker-dealer means they are under a microscope from the SEC and FINRA. Any misstep here can lead to hefty fines or even shutting down parts of their business. This is a standard but important risk. They admit their stock price can swing wildly. Given the large number of shares possibly coming to market from existing investors, this volatility is a real concern. Let's check out who owns how much. MHC Securities LLC is a big player owning over 11 million shares, about 54% of the company. That's a significant chunk of control. The management team, including the CEO Craig Gould, holds a much smaller percentage. When you look at these numbers, it's clear that MHC Securities holds a dominant position. This means their decisions can heavily influence the company's direction. This table confirms what we saw earlier. MHC Securities LLC is listed as a major selling security holder for over 11 million shares. It shows a clear intention by some major shareholders to sell their holdings. Let's peek at the balance sheet. As of June 2025, total assets were about $67.8 million. But check this out, liabilities were close to $51.4 million. That's a lot of debt. They also have this redeemable Series A convertible preferred stock, which is counted as mezzanine equity, not truly equity. With 1.5 million shares outstanding, this represents another $15.3 million that could eventually need to be repaid or converted. Looking at their operations for the second quarter of 2025, they had a net loss of $0.7 million. While that's better than the $0.7 million loss in the same quarter last year, it's still a net loss. Their total revenue did increase, however, reaching $41.5 million in the second quarter of 2025, up from $40.6 million in the prior year. So revenue is growing, albeit slowly. Let's quickly look at cash flow. For the first 6 months of 2025, they generated over $1.1 million from operations. That's a big improvement from using to cash tashin. So they are getting better at turning their operations into cash. Financing activities show they paid down debt by about $1 million in the first half of 2025, which is a positive sign for managing their debt. Scrollfath vinipentaged Pebbly accounting firm Prey. And here we have the auditor's opinion. FGMK LLC says the financial statements present fairly. That's standard, but it's good to see they've passed the audit. So what's the story here with Binah Capital Group? On one hand, they're growing their revenue and managing their direct costs better. They've brought in more cash from operations and reduced their debt. This suggests they are taking steps in the right direction to become more stable. However, there are significant risks. The large number of shares potentially available for resale could create downward pressure on the stock price. They're still losing money overall and have substantial liabilities. The reliance on advisors not directly employed by them also presents a persistent risk to their reputation and legal standing. Binah Capital seems to be in a transitional phase, trying to solidify its business after a major deal. The financials show some progress, but the risks, especially around the sheer volume of potential resales and ongoing losses, mean investors need to tread carefully. It'll be crucial to see if they can convert that revenue growth into actual profits and manage those advisor risks effectively. Alright, that's our breakdown of Binah Capital's latest filing. What's your take on these numbers, and what do they signal for the company's future? Drop your thoughts in the comments. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives into corporate filings. Don't forget to check out the Discord in the description below for more exclusive content and discussions. Thanks for watching. See you next time.